Hi everyone, it's Caitlin and welcome back to Your Financial Journey. When it comes to borrowing money, one of the most important decisions you'll face is choosing between a fixed and a variable interest rate loan. And that is what we'll be talking about in today's video. But before diving into the differences between fixed and variable interest rate loans, let's start with some basics. What is a loan? A loan is a financial agreement under which a lender, usually a bank or credit card company, gives a borrower, in this case you, a specific amount of money, with the understanding that the borrower will repay the amount over time, usually with extra interest on top. The amount that you borrowed initially is called the principal, and the interest that you pay on top is called the cost of borrowing that money. Loans can be used for many purposes, such as buying a house, paying for education, financing a car, or covering unexpected expenses. Loans are typically repaid in regular installments over a set period. Now, the interest that you will pay on top of the principal can be charged at either a fixed or a variable rate, which brings us to the heart of the matter. What's the difference between fixed and variable rate loans? Fixed rate loans. A fixed rate loan has an interest rate that stays the same throughout the life of the loan, let's say 7%. This means your loan payments should stay exactly the same month after month, which makes it easier to plan and budget. Fixed-rate loans are popular for long-term borrowing, like 15 or 30-year mortgages, because they offer predictability. The key advantage of a fixed-rate loan is stability. Regardless of what happens in the broader economy, whether interest rates go up or inflation rises, your rate won't change. This makes fixed-rate loans a good choice for borrowers who want long-term certainty, and in particular, when they can lock in low interest rates. However, there are drawbacks. Fixed-rate loans usually start out with higher interest rates compared to variable-rate loans, which we'll get to shortly. And if you take out a fixed-rate loan when interest rates are high, then you won't benefit if interest rates in the market go down later on unless you refinance your loan, which may involve fees, paperwork, and qualifying again. If you're new to refinancing is the process of replacing an existing loan with a new loan, usually to get better terms, like a lower interest rate, reduced monthly payments, or a different repayment timeline. People commonly refinance mortgages, auto loans, and student loans to save money or adjust their financial strategy. But more on refinancing in future videos, if there's enough interest. For today's video, let's move on now to variable rate loans. Variable rate loans. Variable rate loans, also known as adjustable rate loans, have interest rates that can change over time. The interest rate usually gets adjusted periodically based on a benchmark index, or base rate in the market, plus a fixed margin on top. Check out this video here from my sister Ava if you want more details on how the benchmark index works. Credit card debt, for example, is like a variable rate loan. The rates that you will be charged on your credit card balance will usually be adjusted when the underlying index changes. For instance, if you pay 20% now, this could go up to 21% or more if the underlying index increases, or fall to 19% or less if the underlying index goes down. And even when the underlying index has not changed at all, the credit card company can still change the interest rate that they'll charge you on new credit card purchases. They just have to give you 45 days notice before doing so. It's the same, in principle, for long-term loans, although there is often a twist, especially for mortgages. Long-term mortgages sometimes begin with a fixed introductory rate that remains the same for a certain period of time, say for 2, 3, or 5 years. After this introductory period is over, the interest rate for the remaining time of your mortgage, maybe the next 10 or 15 or 20 years, will be adjusted periodically to the underlying index, typically once a year. Now, when you shop for a loan, like a long-term mortgage, you will often find that a variable rate mortgage has a lower initial interest rate during the introductory period than the rate that you would get on a fixed rate mortgage. This means that monthly payments are generally lower in the early years of a variable rate mortgage. And with the variable rate, you could also benefit from falling interest rates later on, which would lower your payments without needing to refinance. But as my parents often say, there's no such thing as a free lunch in the world of money. The reason that a variable rate mortgage will usually be cheaper than the fixed rate mortgage is because the variable rate mortgage leaves the risk that rates may go up in the future squarely on your shoulders. And if that were to actually happen, you might experience a real payment shock. If interest rates rise sharply, your monthly payments would increase in parallel, and sometimes dramatically so. This unpredictability can make budgeting difficult, and some borrowers may find themselves unable to keep up with higher payments. You would not experience such a payment shock with a fixed-rate mortgage. Regardless of how high the underlying index and market rates increase later on, your monthly payments will always stay the same with a fixed-rate mortgage. But the flip side is that the bank will charge you an initially somewhat higher interest rate compared to the variable starting rate as a premium for assuming this risk for you. 6 tips for choosing the right loan. Choosing between a fixed or variable rate loan depends on a number of factors, including your financial goals, how long you plan to hold the loan, the market environment, risk tolerance, etc. But here are some tips to help you decide. Tip number 1, consider your time horizon. If you plan to stay in the loan for a long time, a fixed rate loan provides stability. If you expect to repay it quickly, a variable rate might save you some money. Tip number 2, see what's happening in the marketplace. When interest rates are low and you expect them to go higher, you may want to lock in those low rates now if you have a somewhat longer time horizon. When interest rates are high and you expect them to go lower, you may want to go with a variable rate loan to take advantage of future interest rate drops. Tip number 3, evaluate your risk tolerance. If unpredictable payments would stress you out, stick with a fixed rate for peace of mind. But if you're comfortable with some financial risk, a variable rate could work. Tip number 4, check your budget. Make sure you can afford potential payment increases if you choose a variable rate loan. Tip number 5, review rate caps. If you opt for a variable rate, understand whether there are some limits in place as to the maximum possible rate change and how much your payment could increase. Some long-term variable mortgages do offer some of these features that may mitigate the risk from interest rate changes a bit. Tip number 6, compare total cost. Don't just focus on the initial interest rate. Consider fees, closing costs, and total interest paid over the entire life of the loan. Here's a table summarizing the key advantages and disadvantages of fixed versus variable rate loans. For fixed rate loans, the key advantages are predictable payments, protection from rising interest rates, and easier budgeting. And the key disadvantages are a higher initial rate, no benefit from falling interest rates, and refinancing needed to change terms. For variable rate loans, the key advantages are a lower initial rate and potential to benefit from rate drops. And the key disadvantages are the risk of payment increases, greater difficulty in budgeting, and often more complex terms. Is a fixed or variable rate loan better for you? Your financial situation is unique, so the right type of loan will depend on a number of factors as we just discussed. If you value stability and plan to keep the loan for a long time, and you think interest rates will go up, a fixed rate loan is likely the better choice. If you're planning to pay off the loan early, sell the finance asset soon, or believe interest rates will stay low or decrease, a variable rate loan could save you money. Understanding the differences between fixed and variable rate loans can help you make smarter financial decisions and avoid surprises down the road. Always consider your budget, risk tolerance, market expectations, and how long you plan to hold the loan before making a choice. Whether you go fixed or variable, the key is to choose the loan that fits your personal circumstances and preferences over the entire life of the loan. Do not look just at the initial interest rate. Okay, my financial friend, I hope you found this video helpful. And if you want to learn more about how the interest rates on your loans and credit cards are set, then check out my sister Ava's video here on the Fed funds rate, prime rate, and SOFR. Thanks for watching, and we'll see you again next time.